As a financial advisor, a lot of the retirees that I talk to want to give generously to their churches, missions, to causes that they really care about, but they're not sure exactly how to do it wisely. So that's why I wanted to make this video here to walk you through how charitable giving actually works in retirement, what's deductible, what's not, and just how you can maximize your generosity and be tax efficient. I love that you have a generous spirit, but I also don't want you to give the IRS any tips. So let's walk through exactly how all of this works. And before we jump in here, just want you to remember just education here. This is not necessarily any specific tax, legal, investment advice for your situation, just because I don't necessarily know your situation. So giving, why do you give? For the tax deduction, I don't think that's a great way to start. I think you should be giving not to save on taxes, but because generosity is a part of your calling, part of your life, you're giving to things that are important to you. So I think that it's important to have the mindset that the tax deduction is the bonus, not the reason for the giving. Let's break down gifts versus charitable donations. So the IRS doesn't consider personal gifts like giving money to kids, friends, or neighbors as tax deductible. So not a tax deductible donation there. Only charitable gifts to qualified organizations count. So those are your 501c3 organizations, some of your churches, faith-based nonprofits, ministries, hospitals, schools, a lot of different nonprofits meet those standards there. Just as an example, so you give $500 to your grandchildren, that is not tax deductible. Then again, you give $500 to your church, who is a registered 501c3, that is tax deductible. Additionally, let's just walk through what actually does count as a donation. The straightforward case is cash, checks, electronic transfers, giving through your credit card, where you're just giving a hard dollar amount. That is, of course, deductible, counts as a donation. Non-cash donations such as clothes, furniture, appreciated stock, real estate, things like that, also deductible at their fair market value. You unfortunately can't deduct time you give, so volunteering doesn't count as deductible even if you have a high hourly rate, things like that. And if you receive anything in return, let's say you give $100 to go to a charity dinner and you get the equivalent of a $40 dinner. Well, in that case, only $60 is deductible. You have to net out the dinner that you got. And as you're keeping track of these donations throughout the year, here is the rule around how you should be looking to document those. An expense that's under $250, you'd want to keep a receipt or written record of that. $250 to $500, you need a written acknowledgement from the organization. $500 to $5,000, you need to file IRS Form 8283 with your tax return. And then when you are giving property that's valued over $5,000, you also need a qualified appraisal for that as well to show the value of it. Just a tip here, keep a giving folder digital file with all your donation receipts. It simplifies things for tax season, makes it easier for you to know where everything's at, and then your accountant will love you even more. And then there are also actually deduction limits as far as how much you can deduct against your income. With cash gifts, you can give up to 60% of your adjusted gross income. With appreciated assets like stocks, for example, you can give up to 30% of your adjusted gross income. And then with tangible goods, you can typically give about 50% of your adjusted gross income. So for example, if you're giving cash away, your adjusted gross income is $100,000, you're able to give away $70,000 away to a charity of your choice, you'd actually only be able to deduct $60,000 in that year because that's 60% of that $100,000. You can't deduct the whole $70,000. But unused deductions can carry forward for up to 5 years. So that's not necessarily a wasted deduction, at least from a tax perspective. And then once you hit retirement specifically, there are some changes that impact your charitable giving. One example is that when you turn 73, for some of you, if you're just now entering retirement, maybe 75, you have to start taking those required minimum distributions from your qualified retirement account, so from your IRAs and 401ks, once you hit that age. And a technique here, once you have to start taking those required minimum distributions, is that you can actually send those straight to a charity of your choice and not have to pay taxes on that distribution. That's the whole point of why the IRS makes you take those required minimum distributions, so that they can collect their taxes, but you can send that straight to a charity and not have to pay taxes on that required minimum distribution. It's called a qualified charitable distribution. And you actually can start doing those qualified charitable distributions at age 70 and a half. You don't have to wait till required minimum distribution age. With those qualified charitable distributions, you can give up to $100,000 a year from those qualified retirement accounts. And from a retirement planning perspective, those qualified charitable distributions are helpful because they can help keep your income lower. If you're not necessarily needing the income from those required minimum distributions, they can raise your taxable income unnecessarily and cause you to pay more taxes, possibly pay more in IRMAA surcharges, different things like that. So doing those qualified charitable distributions, if you're charitably inclined, allows you to keep that income low, not pay more in taxes than you need to be. Another helpful tool is a donor advised fund. So donor advised funds are where you can be putting money into an account, and that money can be invested to be grown and then given from that account straight to qualified charities. And donor advised funds are really helpful because they allow you to actually bunch multiple years of giving into one large gift, and that helps you to maximize your deductions. Say if you weren't going to be able to give enough in one year to be able to itemize, you would only be taking that standard deduction. Well, maybe you can lump a couple years of giving into a single year and be able to itemize that year, whereas in each of those individual years you wouldn't have been able to itemize. So that's a helpful strategy. I was just mentioning this, but another important thing to realize with your charitable giving is that you only get credit for charitable donations and being tax deductible if you're able to itemize. So if you aren't having enough expenses that you can itemize, your mortgage, interest, charitable donations, medical expenses, those types of various things, then from a tax perspective, all of that giving does not give you any benefit other than, like we said before, you're giving to be generous and to give these causes you care about, but you're not getting that tax benefit. So if your total deduction amount is below the standard deduction, then you don't get any extra tax savings. You're just going to take that standard deduction. So this is where, like I was mentioning with that donor advised fund, it's helpful to bunch your donations every few years to exceed that standard deduction every other year so that you can get some of that tax benefit with your giving as well. And really what I'm talking about here with talking through this, it's a word I speak about often if you have been following this channel through the last couple months. It's stewardship. Stewardship is what I want to be solving for. It's what I want to be helping you do better. When you give intentionally and also tax efficiently, you are actually able to stretch every dollar a bit further for kingdom impact. And I don't know about you, but I want more of my dollars in the kingdom doing kingdom work, because I think God really can bring about more of a return on those dollars than we can. So I want all of the dollars I can out there working for his kingdom so that he can bring about a return that is for eternity, for his glory. And to recap some of the things that we have discussed, we want to make sure that we're giving from the heart, not for the tax break. Make sure to document everything appropriately so that you can get credit for those donations and deductions. Use various smart giving tools like qualified charitable distributions, donor advised funds to maximize your impact, and keep giving simple and keep it joyful. Don't make it a stressful thing where you have to plan, strategize, do all these various things. Yes, optimize, but don't let the optimization become the end. Give from a place to where it brings you immense joy and where you get to see impact be made. If you found this video helpful, comment with any questions or thoughts that you have. Make sure that you also like and subscribe so that other people like you can find this content and help it inform how they're being good stewards in retirement. And just as a reminder, generosity doesn't end when you retire. In many ways, it's just beginning. This new season is full of different ways where you can live out your generosity journey. I hope you have a great rest of your week, and we will see you in the next video. Take care.